2025 marks a break in that pattern, a significant break. Both of those nations show reduced re-exporting of Russian gold, with no sign of Russian-sourced gold coming into them. This is despite annual Russian production of approximately 330 tons. Now, that is gold on the exchange. That has been on the exchange, but now it's under warrant, meaning it's not available for those who would like to purchase it because it is now spoken for. That gold is there, but you can't have it. That's 86,565 kilograms, and it's risen 25-fold this year. That's what China has done. China has also effectively made less gold available to the market.
So that's one of the signs that we're in a super cycle. We're getting this kind of feeding frenzy of people wanting in. And from a long-term standpoint, we're really, we got a measured move. The next upside target for gold is about $5,100 per ounce US.
In this insightful analysis, Vince Lanci and Chris Vermeulen examine the dramatic shifts in the global gold market in 2025 and what it means for investors. China and other major players are reducing the re-export of Russian gold, while Russian production continues at around 330 tons annually. Much of this gold is now under warrant, meaning it's unavailable for purchase, effectively tightening supply. China's actions have significantly reduced the amount of gold accessible on the open market, fueling what many analysts are calling a gold supercycle. With demand surging and supply constrained, market dynamics point to a potential measured move toward $5,100 per ounce. This video explores these trends and the implications for investors looking to position themselves strategically. If you found this video insightful, don't forget to hit the like button, share it with others, subscribe to the channel, turn on the notification bell so you never miss an update, and drop your thoughts in the comments below.
Since 2022, when the Ukraine-Russian war started, Russia's gold exports have largely moved through CIS nations, such as Kazakhstan and Uzbekistan, to bypass Western sanctions. The UK and Switzerland were off the list for them to export to. Yet, 2025 marks a break in that pattern, a significant break. Both of those nations show reduced re-exporting of Russian gold, with no sign of Russian-sourced gold coming into them. This is despite annual Russian production of approximately 330 tons. So the first question is, why are they not exporting gold like they did in 22, 23, and 24? Well, it gets more interesting. If they're not exporting the gold, where's it going? Well, neither is there any increase in Russia's central bank holdings or recorded domestic foreign sales. That's the red line in the graph there. This leaves up to $24 billion or 186 metric tons in unaccounted for gold and a growing mystery over its destination. Taken together, this data suggests Russia has drastically reduced exporting gold, but without any visible domestic absorption to explain where it went. We have a tentative conclusion. Russia now appears to be quietly hoarding gold. This accumulation coincides with rising military expenditures and constrained access to foreign currency markets, conditions that would normally push Moscow to liquidate bullion and has done so in 22, 23, and 24, 23 and 24 especially, not retain it. The simultaneous withdrawal of Russian supply on the global market, whether it be directly or through proxies, and China's aggressive acquisition of metal from Shanghai vaults points to a coordinated shift in gold's global function. And there's a picture of the Shanghai exchange warrants. Now, that is gold on the exchange. That has been on the exchange, but now it's under warrant, meaning it's not available for those who would like to purchase it because it is now spoken for. That gold is there, but you can't have it. That's 86,565 kilograms, and it's risen 25-fold this year. That's what China has done. China has also effectively made less gold available to the market. Hoarding would be the word I would describe it. This is something we have discussed before last month, and no one really has discussed it other than us and Eric Young. Gold as a repo asset on the global stage. We're not sure, but this is something that must be watched closely.
The technical side. So when we look at the charts, like from a long-term standpoint, there's no doubt gold or the precious metal space is in a bull market. Gold's got a very strong chart pattern. We're in, it's been a bit of a feeding frenzy over the past month, two or three months. People have really been piling into the this space, and we've seen it really come to life. Gold was seen as pretty boring. The precious metal space was getting some attention, but we've really seen a lot of money move into pretty much all parts, the whole precious metal complex. We've seen money move into not only gold, but we've seen silver, big volume in silver, big volume in gold miners, silver miners, platinum and palladium. So it's not just people now kind of moving into one particular pocket of precious metals. It's like they want anything to do with precious metals, they're in. Even like different ETFs like XME, copper miners, anything that has the word miner in it has been getting attraction. And so that's one of the signs that we're in a super cycle. We're getting this kind of feeding frenzy of people wanting in. And from a long-term standpoint, we're really, we got a measured move. The next upside target for gold is about $5,100 per ounce US. So there's some pretty good upside potential once the gold kind of finishes kind of trying to shake the market out a little bit. The recent pullback, I think, for some reason caught a lot of people off guard, although it shouldn't have, because the market was saying it needed a bit of a break.
Right.
And so I think it's stabilizing. So I'm bullish on gold here still. Yeah, I think you should have limited exposure to the stock market. I mean, we've had a very strong move up percentage wise, but the stock market isn't super healthy at this point. The Mag 7s are still doing most of the heavy lifting. Gold is telling us that there's something wrong. Something's going to break eventually, and there's going to be some type of financial crisis. I think going forward, people need to realize sometimes you need to step aside. Cash is actually a very good position. It's one of the best positions when all hell breaks loose and everything is collapsing. People will be more than happy to be sitting in cash without being stuck in the stock market or commodities. Because if we do, it's more so when we get a financial reset. They're always going to happen. There's always going to be things that break and we have a financial crash. The question is just when. And I think people just need to realize that you need to have a game plan to know when trends change direction and when one of these may be starting so you can move to the sidelines. And I think precious metals is still the hot pocket. I still think we're going to see another big push and leg higher. If you compare the price action of precious metal space with platinum, palladium, gold, silver miners to 2007, early 2008, it's almost identical type of price action. And it's telling us we should see another 30% move up in gold, potentially another 60% move higher in silver, platinum, and palladium. So I think this first pullback in metals is just the tip of the iceberg. I think we're going to see one more big push.
In this detailed analysis, Vince Lanci and Chris Vermeulen break down the current dynamics in the global gold and precious metals market. Since 2022, Russian gold exports have shifted through CIS nations, but 2025 marks a significant change with reduced flows and signs of quiet hoarding. At the same time, China has tightened access to gold through Shanghai vaults, reducing market availability and fueling a precious metals supercycle. Investors are piling into gold, silver, platinum, and palladium, reflecting a feeding frenzy across the sector. With long-term charts pointing to strong upside and measured moves, there's potential for gold to reach $5,100 per ounce, while silver and other metals may see even larger gains. Strategic positioning and awareness of market cycles remain critical. Let's get into the interview.
Silver back above 50. Deutsche Bank gold correction. U.S. overtakes China in African metals investing. That's a news item. It's actually pretty interesting. Came out of BBC. Founders First Look, that's a comment on the SocGen report, and the GolfX PM recap. I identified a new ledge, thinking we'd bounce around in here. Well, we went there one more time, and the next day, yesterday, it just obliterated it. Now, I had warned that this was an echo of this sell-off. This is like, someone really big selling it, wink, wink, someone sovereign selling it. And this was an echo of them selling it again to keep it down. It's the double tap. And I thought that this might be a level that will not get broken through. So my alarm went off here. And here we are scooting through that level, just blowing it away. And now we're bumping up against this. So I would say to you that since we're above this, we should, as long as we stay above 4,100, call it, 4,250, 4,300 are on the radar with a stop here. We have to get above this area right here, okay? And we may get above this area on a gap tomorrow morning. But just keep that in mind that this is where it was sold last time. Now, if you're bullish, like I am, you're looking at this saying, well, why is it stopping? Should I be bearish? No, the market is sniffing out to see if the selling is still there. And if it's still there, it'll retreat. It won't take it on because it was big. If it's not there, it'll keep bumping up against it for a couple of days, and then one day it'll just pop through it. Anyway, that's my impression of things. Silver's easier, right? Here's your consolidation. Through here, we should run up. Let me see if I have do I still have the lines on this one? Yeah. Through here, we should run up. I didn't draw a line on this one, but we should go to 52.50 as long as we're above, 49.40. Now it's a little bit too high to be risking one to make one, but that's my level, right? In here, we're up there. If you want to look at it like from a very simple structure concept, you would say this here is a structure. This is the market, right? And this area up here, that's the froth, right? That got worked off. Same thing for gold. Viewed together, Russia's withholding of exports and China's absorption of supply suggest preparation for a parallel collateral market anchored in gold as opposed to U.S. Treasuries, as we have suggested. It's conjecture at best, but the evidence is there. Where is the Russian gold going? Just as an aside, the Russian gold exports in 23 and 24, how they grew? Well, they grew in line with Russian military expenses. You sell more gold to finance your military expenses. But in 25, Russia's military expenses are up 25%, and yet their exports are down below 22 level.
In this market update, market analysts break down recent movements in silver and gold, highlighting critical levels and underlying global trends. Silver has bounced back above $50, showing strong consolidation and the potential to push toward $52.50, while gold faces key resistance near $4,250 to $4,300. Observing past sell-offs, there are signs of large sovereign players managing supply to influence the market, but current momentum suggests potential upside. Coupled with Russia's reduced gold exports and China's absorption of available supply, the market may be positioning for a parallel collateral system centered on gold rather than traditional U.S. Treasuries. Technical structure and geopolitical factors are aligning to create unique opportunities in both silver and gold. If you found this video insightful, don't forget to hit the like button, share it with others, subscribe to the channel, turn on the notification bell so you never miss an update, and drop your thoughts in the comments below.